ask the organizers if we could potentially start recording. Thank you. Okay, so I'm already sharing my screen, so you should all be able to see. And we're going to start with a little bit of background about what Learning Unit 6 is and adjustments, and then we will get into the actual e-tutor question for Learning Unit 6. Okay, so I'll hand over to my colleague, Maurice, who will start with the first section.
Okay, good evening, students and colleagues. Can you hear me? Am I audible?
Yes, you are. Thank you.
Okay. The adjustments are how do they arise, these adjustments? Now, if you remember in Unit 1, we have an accrual basis of accounting. And that accrual basis of accounting stipulates that income and expenses are recognized only when they occur and not when the money is paid or received. Let me repeat that. I'll try to be slow so that the students can understand. We record income and expenses in the financial year in which they occur and not in the period in which the money is received. So in other words, the money might not be received, but the expense or the income might have occurred, or the money might have been received more than what was supposed to have received for that period. Are you with me? So that's how the adjustment come about. So I will just explain the various adjustments, and my colleague Letitia will put in the figures and the debits and the credits according to the study unit. Okay, so the first expense adjustment, sorry, is a prepaid expense. A prepaid expense is an expense that has been paid in the current financial period of the entity, where all or part of the expense relate to future financial periods. So in a financial period, we've got 12 months. So if we have paid for that expense for 13 months, what we need to do in the financial statements is to adjust that 1 month that pertains to the following year only, so that we can only record the one that pertains to this financial year. So therefore, the accounting would be to reduce the portion that relates to the future period, e.g. 2000. You then reduce the expense by crediting it and debiting the prepaid. I hope you got me, or you want me to repeat? Okay, I will repeat. So if a certain portion of the expense relates to the following year, it means it is a prepaid expense. So therefore, we'll adjust the the rent account or that particular expense by crediting it and debiting the prepaid expense. Okay, and then Letitia will illustrate how that is done when she does the exercise. Then the next one is the accrued expense, which is the opposite of the prepaid expense. An accrued expense is an expense that relates to the current financial period, but is still unpaid at the end of the period. Most of these expenses would be like your municipal rates and taxes, and electricity. The municipal guys will come and do the readings, and the expense will be paid at the month later. So how do we adjust that? We adjust that by debiting the portion that has not been paid but has been realized and crediting the accrued expense. So that is the exact opposite of what happened on the first one. And then the next one, it's a consumable inventory on hand. The consumables are all expenses with regard to inventory bought, but not for sale, but for use in the process of any income. For example, stationery and packaging material. There will be some inventory left at the end of the year, financial year, that can be counted, a closing amount which can be determined. What does that mean? That means that if we bought stationery for 15,000 rands, it would have been expensed. But then at the end of the year, if 2,000 of that stationery is on hand, it should be adjusted by crediting the consumables and debiting the consumables inventory. I will repeat that. The portion of the consumables which has not been sorry, the portion of that of the consumables that has not been consumed at the end of the financial period, it will be regarded as consumable inventory. So therefore, we're going to reduce the consumables expense by that amount of the inventory and debit that inventory. And by the way, something else that I nearly forgot is that all these entries that so far we've spoken about will be reversed at the beginning of the next financial period. And then the fourth one would be the income received in advance. Income received in advance is income that has been received during the current financial period, but relates to the future financial period. Only the portion relating to the current financial period must be recorded as income, and adjustment is necessary for the portion that is received in advance. So, for instance, if you received rent or interest for 13 months, that means in your records or financial records, you must adjust for the one extra month that belongs to the following year. So how do you do that? You do that by debiting the income, interest income or rent income, whatever income, and then crediting the the income received in advance. I'm going to repeat that. The portion of the income that relates to the future financial period has to be adjusted by debiting the interest income and crediting the income received in advance. I hope you got that one. Next page, ma'am.
Maybe before we go to the next page, I'm also just monitoring the chat on the side as you're going through it. There was a request just to repeat the consumable section, please, before we continue.
Okay.
Maurice again. Oh, sorry, Maurice. Can you try to adjust the screen? I think they can't see the font there. Maybe just try to put it in the presentation mode.
It is in the presentation format. What you need to do is to go to View and click on the Focused on the Content, and then that will make the presentation bigger.
Okay, I hope they are listening. It's fine. Thanks.
Did it work?
It's fine from my side. I see one of the students is saying they can't see.
Okay. So one of the students needs to do that. Okay, let me repeat the consumables inventory on hand. The consumables are expenses with regard to inventory bought, but not for sale, but for use in earning of income. For example, your stationery and your packaging material. The physical inventory left at the end of the year can be counted and closing amount can be determined. And then that inventory that was counted, the value of that inventory will have to reduce the consumables expense because not all of it was used, by crediting consumables and debiting inventory. Must I repeat that? Okay, let me repeat it. The portion of the inventory that was not used, which is stock on hand, would be to debit the inventory on hand and credit the consumables, which reduces the expense to the amount for which it was used for that particular period. I hope that is clear now.
Yes,
Page
I think
down.
so.
Okay, page down. Okay. And then we've got accrued income. Accrued income is income that relates to the current financial period, but has not yet been received. Remember what I said? I said that the accrual principle of accounting is that we realize or record all expenses and income when they occur as opposed to when they are paid. So in this particular case, we have an income that has not been paid by the end of the month, but we have to account for it. So therefore what we do is we credit the income and debit the accrued income. We credit the income and debit the income accrued. Okay. My colleague will illustrate this by the examples in the assessment question. Then the next one is credit losses. In brackets, it's bad debts. What does that mean? That means that when a credit transaction occurs, there is always a possibility that it might not be paid. Such a debt that is never paid is known as credit loss or irrecoverable debt or bad debt. So it's money that a debtor owes you, but the debtor is not in a position to pay you. So that becomes a bad debt. The amount will never be paid by the debtor, but will be written off on the account called credit losses, which will be written off as a loss to the profit or loss account. At the end of the financial period, the debtor will then owe the entity no more. How do we account for that? We account for that by crediting the loss, debiting the loss expense or bad debts and crediting the trade receivables. So your trade receivables or debtors will be reduced, and then we've created an expense. I hope that is clear. And then the next one is the long-term adjustment, which is depreciation. What is depreciation? When a business entity buys tangible assets, that is plant, property, and equipment that are not for resale, but are used in operation of the business, as these assets are used, they decrease in value. This decline in value of a tangible asset is charged against profits of the business and is spread or apportioned over the expected useful life of the asset. The apportionment of the cost of the asset usually takes the form of a depreciation entry. So if we estimate that a particular asset is its useful life is gonna be 5 years, that means we're gonna be depreciating that asset every year by 20%. And it doesn't mean that at the end of the 5 years that asset is not gonna be there, but it only means that the useful life of that asset is gonna be 0 after 5 years. So therefore, how do we treat it? We treat it by depreciating the asset, debiting the depreciation, and crediting the accumulated depreciation. I'm going to repeat that. Depreciation is the diminishing value of a useful life of an asset over a period of time. And then we apportion it on a yearly basis according to the estimate that we've used that the asset will be useful for 5 years. So at the end of the financial period, we will then debit depreciation and credit accumulated depreciation. I hope that there are no questions. Or if there are any questions, please ask.
I think there's one question. The students are not able to unmute, so we've asked that they type the questions on the chat because everyone is muted. So there's only one that I haven't yet answered. I think, Maurice, if you can maybe just explain the difference between depreciation and accumulated depreciation.
Okay, The depreciation is an expense that will be recorded in the profit and loss statement as an expense, and the accumulated depreciation will go to the balance sheet, where in the balance sheet under that particular asset, you're gonna have the asset value less the accumulated depreciation account. So the accumulated depreciation goes to the balance sheet and the depreciation goes to the profit and loss account or income statement. Is that clear? The depreciation, the accumulated depreciation reduces the cost of the asset. In the balance sheet, we record the cost of the asset. We record assets at cost, but then the ones that we depreciate, they will reduce by the amount of the accumulated depreciation. Is that all? Is that fine?
Okay, Maurice.
Yes.
Okay, Maurice. A quick one. One of the students is asking, what do you mean by interest income?
Interest income is when you renting out a building or a room or a flat. The money you get for renting out that room or flat or whatever is interest income. And as you know, income, we credit income.
Okay.
Maybe I can also just jump in as well. We are still going to go into the e-tutor question. And in the details of the e-tutor question, there will be examples of all of these. So perhaps we can look at it as we go through the e-tutor question, if that's okay. Because I see there's a lot of questions about commission income, interest income, and I think it will be quite detailedly described as we go through the learning unit. Okay. So thank you for that, Maurice. So I will then take over and go into the next part of it. So now we've just given you guys a high level overview of what the type of adjustments are. And now we will put that into a practical scenario with the e-tutor question in Learning Unit 6. So the e-tutor question in Learning Unit 6 starts off as follows. They provide us with a pre-adjustment trial balance for Sina Mover distributors as of the 31st of December 20.1. So that would be the financial year. They also give us a list of items that's already been recorded in the trial balance. So if I just go through it, I'll go through it high level, and then we'll go to the next part where we look at the required, and we'll go through each step as we go on. So the first thing they show us, there's capital, which is a credit balance. Then they've got assets. So if we look, there's land and building, vehicles and equipment, all at their cost price. That's showing on the debit side. We've got accumulated depreciation, which is showing on the credit side. So that, as Maurice has explained, the accumulated depreciation is us writing down the value of the asset over its useful life. There will also be an example where we can look at how it's calculated a bit later. Then we have fixed deposit. So this is an asset, something similar to a bank account or an investment. We've got some inventory on hand, which is merchandise. That would be inventory. Trade receivables. So this would also be an asset where we are owed money from customers. We've got our bank account, some petty cash and cash float. So all also still assets. And then we look at some of our liabilities, which is sitting on the credit side. So this is everything where we owe somebody something. So we've got the trade payables control account, long-term borrowing. So that would be a loan that we've got with being limited. We've got allowance for credit losses, and that's then where the balance sheet ends. So that's our assets and liabilities. And then if we look at the next section, this would be our income statement. It starts with sales of 165,000. We've got cost of sales and some sales returns, and then a lot of different types of expenses that we've incurred during the year. So I won't go through all of them. And right at the bottom, there's some income that we've received as well during the year. So as we go on, this would have been the first thing that they've given us. So you guys would analyze that as a start. And then the next thing would be, so what do we do with this information? What is the required? So they give us a whole section. They basically tell us the financial years from January to December 20.1, and they then give us additional information from 2.1 to 2.11. And they say, I will go through each of these individually as we go. The required says prepare the journal entries to record the adjustments above. So essentially, we're going to go through each of these and then decide how to record them, what is the debits and what is the credits based on what type of adjustment. So just to remind you guys, the types of adjustment is what Maurice started off with, explaining to you guys. So we'll go through each one, identify what is the type, and then determine what is the journal entry and how do we calculate the amount. So what I will do is, I thought before we start, just to remind you guys of what the difference is between an asset and a liability. So an asset, debits are on the are positives, and that is why I've got it in green. Credits are negatives, they reduce your asset value, and that's why it's red. Liabilities are the opposite. Liabilities, a credit increases and a debit decreases. Okay, so if we now start and look at the first one. So in the additional information, 2.1 says packaging material on hand at the 31st of December to the value of 980 Rand. So by that statement, packaging material on hand, there's an indication that this is inventory and we would need to record it because the required said record all the transactions from 2.1 to 2.11. So the first thing we do is what is the type of adjustment that we're trying to do? So in this case, it's packaging material. It's saying on hand is a good way of determining that it's actually inventory. So that's the first thing we do. An inventory, then we know from the definition, an inventory is an asset. And how would we then record it? They give us the value already, so there's no need to calculate anything. So we would debit inventory. Why? Because we need to increase the value of our asset. How do we increase the value of our asset? We debit it. And we would then credit packaging material of 980 Rand. Okay. I think my colleagues will be monitoring the chat on the side. If you guys have specific questions relating to any one of these, please just put the number that we're discussing, and then I can obviously at any point stop and answer questions as we go. I see a lot of people are saying that they cannot see the screen or that they don't see a picture. So the one thing is, if you guys don't see the screen, you would probably need to log out and come back in. And if you do see the screen and it's blurry, it's probably your reception. So please try and see if you can get some stable internet, because I think majority of the colleagues, and I can see on the chat, are saying that they can see the screen clearly. So just for those who's not seeing it. Yes.
Sorry, ma'am. Whilst you are here, there's a question here which says, is commission income in consumable inventory because we're in the process of earning an income, even if you have received? If someone understands, please enlighten me. It's a little bit, this student is a little bit confused because she's talking about two things. in one?
Yes, the one is inventory, which is what we are discussing here, which is an asset. The other thing is commission income, which is an example of an income received. It's two very different things. I think we will see some or other, I think it's interest income or accrued income later on, which we can then just clarify the difference between commission income and income received in advance or accrued income, because I think the confusion comes in there.
Yes.
Okay. I'll move on to the next one. Okay. 2.2 now says the long-term borrowing was entered into on the 1st of October 20.1, and long-term borrowing, when we looked at the first sheet of the question, which had the pre-adjusting trial balance, we saw long-term borrowing, meaning a loan that we have taken out. So if we are the entity, it's a loan we've taken out. So they're saying that they entered into the loan on the 1st of October. According to the agreement, interest is payable biannually, meaning twice a year, at a rate of 18% per annum. So by the statement, if we have entered into a loan, which means we need to pay interest on that loan. And if it's not recorded, if we look back at the trial balance, there was no interest income or interest expense, that was indicated on the trial balance. So that means that this statement is saying to us, okay, we've got a loan. Now we need to calculate the interest expense on this loan, because if we take out a loan, we need to pay interest on the loan. So it would be an expense. So the first important information, how much is the long-term loan? On the trial balance, it showed it was 25,000 Rand. So what would this be from a type of adjustment? We've got an expense that we have not yet recorded. So that means it's an accrued expense. It's not recorded in our records yet, so we need to calculate and record it. The next thing would be, how do we do this? Because they're telling us here that interest is payable at a rate of 18% per annum, and we know that the long-term borrowing is 25,000. So the calculation would be 25,000, which is the loan amount, multiplied by the 18%, which is the rate of the loan. And because this loan was only entered into on the 1st of October and our year end is 31 December, we've only had this loan for 3 months. So that means we only need to calculate interest expense for 3 out of 12 months. So that's why I say times by 3 divided by 12. And that gives us 1,125 Rand. So that's the calculation of the interest expense that we owe. What would the journals be? As it's an expense, we would debit interest expense and credit accrued expense. Why is it a debit interest expense? Because the expense is a cost. We owe money. We need to pay the interest on the loan, and the credit is an accrued expense because it has not yet been paid. Okay. I'll just stop again. I see there's quite a few questions, one of them by biannually. So I think when you guys read a question, it's important to just look at what is the rate and has it been calculated or not? Because if I just go back a few steps, sorry, I'm going to have to go back all the way here to this trial balance. If you look at the trial balance here and you look at the expenses, there's wages, salaries, settlement discounts, licenses. There's a lot of expenses, but interest expense is not here, which then tells us that the entity has not yet calculated the interest that we owe on this loan. And so that is how I got to the 3 out of 12 months.
Okay, Letitia?
Yes.
Just to take you a bit back, there's a question here. One of the students is saying, I thought packaging material and inventory is one account, why two? And the next one, I think you can club them together, is why are we crediting packaging material?
Okay, so packaging material is a type of inventory. So you can have many types of inventory. Packaging material would be one of them. So in a question, they could say packaging material, they could say work in progress. There's a few examples of inventory, but the student is correct. Packaging material is inventory. Because they said packaging material in the question, I called it packaging material, but essentially it's the same thing. It is inventory. So that's the first part of the question. The second part of the question, why do we credit? So let's go back again. Why do we credit packaging material? If you go back another few steps, sorry for everybody that if your connection's a bit slow because I'm going back and forth. But if you go back to the trial balance, right? And for those of you who are struggling, you can also just open Learning Unit 6, the e-tutor question, if you have it with you. On the pre-adjusting trial balance, it shows that they've got merchandise here under inventory. And then here at the bottom, it shows packaging materials as a cost. So what this is telling us is that the packaging material was purchased and the expense has been incurred, but it's not recorded as inventory. There's only merchandise sitting as inventory. So in order to record this inventory on hand at the end of the year as inventory, you have to debit inventory so that it becomes an asset on the balance sheet, and then credit packaging material because it's sitting as a cost in the income statement. So you credit packaging material and debit inventory. Okay. Let's go back to the second question that we were on. So we were on 2.2. Don't see any other specific questions here. There was a question that just asked, why do we only calculate for 3 months? So if you read the question, it says that the long-term borrowing was only taken out on the 1st of October and our year end is December. So we only have 3 months of that loan. So we should only calculate interest expense for 3 months of the year. And that is why we take the full amount, 25,000, multiply it by 18% and multiply it for 3 divided by 12 because we only had it for 3 months of the year. So we only need to pay interest for 3 months, not a full year. Hey.
There's a student that is asking you to repeat 2.2.
Okay. I'll repeat it one more time. So essentially the long-term borrowing, so what that is saying is we long-term borrowing is a loan that we are taking out. We took it out on the 1st of October and our year end is 31st of December. That means that we had this loan for 3 months of the year. Took it out on the 1st of October, our year end is 31st of December, so it's October, November, December. It also tells us that interest is payable biannually at a rate of 18% per annum. So what that is saying is the interest rate that we calculate is 18% per annum being for a year. So if the long-term borrowing that we took out was 25,000 and we multiply by 18%, we'd get the interest expense for a full year. But because we only took out the loan in October and we've only had it for 3 months, we multiply it by 3 and divide by 12 to get the 1,125. Okay.
Yes, another one. Why are the amounts of the packaging material different? 2.1 is saying 980, but on income statement is 4,700.
Okay, so on the income statement, it says 4,700 because that's how much we've bought for the whole year. So the 4,700 is what we've bought for the full 12 months. And the question in 2.1 tells us that there's only 980 Rand left of that at year end. So the 4,700 is the full year cost and 980 is what's left at year end. So that's why at year end, we then move the 980 out of the income statement onto the balance sheet as inventory, and the remainder stays in the income statement. So the 4,700 minus the 980 is the amount that then is still already used during that financial year. So it's a valid expense that needed to be recorded in that year. Okay. Okay, I see quite a few questions about accrued expense. Why are we crediting accrued expense? So what's important about this is if you guys recall what Maurice had said initially at the beginning, if you have an expense. Interest expense is an expense. That is correct. That's why we're debiting the expense here. That is the expense in the income statement. The reason why we are crediting accrued expense is because this has not yet been paid. So we are creating a trade payable or it's a liability that we are creating on the balance sheet at year end because we have not paid it. So you debit interest expense in the income statement to say this is a cost and that is why you're debiting the expense. But because it's not yet paid at year end and we still need to physically pay, you would credit accrued expense. And this is on the balance sheet as a liability. If, just as an example, we had paid it during the year. So if the question said we've paid the interest expense and please do the journal entries, we would say debit interest expense and credit bank because we would have paid it during the year. So there's always got to be a debit and credit for any transactions. Okay. I think I'm going to move to the next one so that if there's any other questions, we can keep asking as we go. The next one is advertisements include an amount of 400 Rand paid for January 2022. Okay, so here advertisements is a cost. We know our year end is Jan to December 20.1. And now it's telling us that they've paid an amount for the following year. So that means we've paid in advance. Okay, so if we think of what type that could be, if we recall from the first slide, a prepaid expense is an expense where we pay in advance for the following year. So that is why it's a prepaid expense. And now it's already sitting in our records as an expense. So now we have to remove it as an expense because it's not relating to the current year. If you guys recall correctly, Maurice said income and expenses must be recorded in the correct financial year. So if you have expenses or income recorded for another period, you have to remove it or take it out. And so that is why this will be the journal. We credit advertisement expense because it's sitting in our expenses currently and we need to take it out. So we need to credit it. And we debit prepaid expense, which then becomes an asset on the balance sheet because it's prepaid for the following year. Okay. Okay. Let's move to the next one. Okay, I do see a comment. I'll speak a little bit slower. The next one is rental income. So rental income is money we receive as income. So we are the business. Rental income is money we get from renting a space to somebody. And here it says we have received income for January 20.2. So this is income now that we've received in advance. So it's the opposite of the previous example. The previous example said we paid an expense in advance. Now in this one, we received income in advance. So we've received income for 1 month for the following year. So the amount in the pre-trial balance said it was 15,600. That was the full amount that's recorded. And so the type is income received in advance. So that is the type of adjustment. And now how do we calculate it? Because this rental income that we see in the trial balance is for the whole, it just has an amount. It's recorded for the whole period. And the amount is 15,600. The information is telling us that they've paid for an extra month. So they've paid for 13 months, January to December 20.1, which is 12 months, plus January 20.2. So that's 13 months that we've paid for. What we now need to do is only remove 1 month because the 12 months that are recorded is correct. We should have recorded that rental income. So we need to now remove the 1 month that shouldn't be there. And that is why the calculation says 15,600, which is for the full period, divided by 13, because we've paid for 13 months, times by 1, because it's only 1 month that's paid in advance. That's 1,200 Rand. So of the 15,600 Rand, 1,200 relates to the following year, and therefore we have to remove it from our income. Okay, and so this would be the journal. Rental income is a credit that's currently sitting in our books, 15,600. We need to now reduce it. That's why we debit rental income with 1,200 and we credit income received in advance with 1,200. Okay.
Ma'am, there's a student that is requesting you to repeat 2.3.
Okay, I will go back. I just want to see there is one question about 2.4. So there was a question about the months. So the information tells us that we have received rental income, including the following year, 1 month. So our period is January to December 20.1. That's our financial year. The information is telling us we've also received an extra month. And this is the full amount that we've received in the pre-adjusting trial balance. So that means this is for 13 months because it's 12 months from Jan to December 20.1, plus we've received January 20.2. So that's why it's 13 months. I'm saying the amount that we've received divided by 13 because this is for 13 months and 1 month of it is received in advance. That's why we multiply by the 1. Okay, I will just go back to 2.3. 2.3 is advertisements. So advertisements is a cost we pay as the company. We pay for advertising. And it says it includes an amount of 400 Rand, which is paid for the next year. So like I indicated, the financial years, Jan to December 20.1, we have now paid an expense in advance for 1 month. And here it's giving us the amount. So it's saying it includes an amount of 400 for January. So here we know that the 400 Rand is for January. So we don't have to do any calculations. And therefore, that is why the journal entry is credit advertisement expense because we've already paid it. So it's sitting as an expense currently in our financial year. We need to remove it. So that is why we credit advertisement expense and we debit prepaid expense.
Yeah.
Okay.
Okay. Thank you.
Okay. Then we go to 2.5. So 2.5 says interest on the fixed deposit has not yet been received for the last 2 months of the financial year. So a fixed deposit is something where it's an asset to us. It's similar to a bank account. It's income or money that we have invested somewhere. So if interest has not been calculated yet for 2 months, that firstly means it's interest income because we earn income on our investments. So that's the first thing. It's interest income that we're talking about here. And they're telling us that they have not calculated it yet, which means we can assume it hasn't been recorded. So that means we need to calculate the interest income for those 2 months and record the interest income. They also tell us that the interest is calculated at 12% per annum. So it follows the same logic as we saw with the long-term borrowings. The calculation logic would be the same. So here our fixed deposit is 50,000 and the type would be accrued income. Why would it be accrued income? Because it's income that has not yet been received. So that would mean it's accrued income. How do we calculate it? We would say 50,000, which is the fixed deposit amount, multiplied by the rate that we earn the interest income. And again, just remember always this 12% is per annum. So that if we just said 50,000 times 12%, that would give us 12 months. But they're saying here it's only the last 2 months that they haven't received. That is why we say times 2 divided by 12. That is how we're calculating it. Okay, what would the journal entry be? This is interest income. We have not recorded it. So we would credit interest income. That is a credit in our income statement to show an income, and debit accrued income. Okay. I see there's a question, where's the 50,000 coming from? So on the pre-adjusting trial balance, which was in the first slide of the e-tutor question, it shows the fixed deposit amount of 50,000. So they give it to you in the actual extract. I just pulled it out so that we can explain how we then calculate it. But in the required, you would now need to go to the pre-adjusting trial balance, find the fixed deposit. It will have, say, 50,000, and then you would have to calculate this amount by doing this calculation and then do the journal. Okay. A question about why 2 divided by 12. If you read the question, it says interest income has not been received for the last 2 months. So that is telling us for 10 months we have received it. If a year is Jan to December, Jan to September we have received, or actually Jan to October we've received, we haven't received November and December. And that is why it's only 2 months of interest income that is outstanding that we have not yet received. Okay.
Teacher, I think tackle the next one as well. There's a student who's saying 10 over 12. Why not 10 over 12?
Okay, so the reason why not 10 over 12 is because if we go back, so first, before I go back a few, they're telling us that they have not received the last 2 months. So that means it means that we've received the other 10 months already, and it's in the information. But maybe I can just go back. Sorry, it's going to be a little bit of a moment to go back to or maybe I can just do it a little bit differently. Sorry, let me just open it on the side so I can show you guys the pre-adjusting trial balance in the question. So this might be easier than moving the whole presentation. So here's the pre-adjusting trial balance. And in the pre-adjusting trial balance, for the student that asked, where do I get the 50,000? The information is telling us that interest is calculated on the fixed deposit, and here's the fixed deposit of 50,000. And with regards to the income, it says here interest on investment. If you look at here, it's already shows we've received something. So the question or the information clearly tells us they've only not received 2 months. So that means the other 10 months has been received and recorded, and that would be the 5,000.
Okay.
Okay.
Thanks.
Okay. Then if we go to the next one, okay, we've already done 2.5. So there's only 11 in the required, so we're more than halfway. 2.6 says insurance includes an amount of 750 Rand paid for the period 1st of November to the 31st of October 20.2. So insurance is an expense for us. We are paying it. That's the first thing that's important. And then it tells us there's an amount of 750 Rand that's paid for a period of 1 November to 31 October. So it's 12 months in that period. But very important to remember here, what is our financial year? Our financial year is Jan 20.1 to December 20.1. So that means that this insurance we have paid, is paying for the November and December 20.1 falls within our financial year, and Jan 20.2 to October 20.2 would then form part of our next year. Okay. So if we think of what we've done, insurance is an expense. We've paid it already, so it's prepaid. So that is why the type would be a prepaid expense. Then how would we calculate the prepaid expense portion, which is the portion we've paid for the following year? It's telling us that the 750 Rand is for 12 months, because if you say 1 November to 31 October, that is 12 months. And if you know what our financial year is, you know that 2 months is falling within our financial year, November and December 20.1, and the other 10 months is falling within the following financial year. So that is why I say 750 divided by 12, because it's paid for 12 months, multiplied by 10, because there's 10 months that have been prepaid for the following year. Okay, the journal entry would be, because it's an expense and it's already recorded, we now have to reduce the expense. That is why we credit insurance with 625 and we debit prepaid expense, 625. Okay. Okay, I think I'm going to continue going. If I see there's a few questions from previous sections, I think if we can keep those until the end, I'll answer the questions relating to the current section, and any questions that relate to 2.1 or 2.2 will come back at the end just to avoid continuously going back and coming forward again. Okay. Then if we look at, okay, there's a few people saying 2.6, so let's just stop here for a minute and let me rephrase and just go through some of the questions you guys have. So I think there's a lot of questions regarding the 10 months and the 12 months. So if we think about it, our year is Jan 20.1 to December 20.1. That means we should pay our insurance for that 12-month period. So with the information telling us that insurance includes an amount of 750 Rand paid, that means it's already recorded as an expense in our trial balance. And that 750 Rand relates to 2 months of the current financial year and 10 months of the future financial year, so next year. We know we should only record expenses for the current year, and therefore the future year's expenses we need to now remove as an expense. So this is the reason why the calculation is saying 750 Rand divided by 12, because they tell us that it's paid for 12 months. So divide by 12. And why are we multiplying it by 10? Because 10 months are in the new year. So January 20.2 to October 20.2 is the 10 months of the following year, which should not be recorded in our current year. And that is why we calculate it like that. And that's why we reduce the expense by the 625 Rand. Okay. And the reason why I see a few questions as well with regards to, do we just leave the other 2 months? Yes, we do. So 750 Rand is the total for the 12 months. The 2 months relate to the current year, November and December 20.1. So we leave it in our records because it's correct that it's recorded in the financial year. It's 2 months where we've incurred that insurance cost. So we leave those 2 months as an expense. It's a valid expense. We only move what is recorded for the next month. Okay. And I'll move on to the next one. Okay, so the next one says the telephone account of 165 Rand for December 20.1 has not yet been paid. So telephone account, we can already think that must be an expense for us. And it's saying, it's also defining it here that it has not been paid. So that indicates to us that we have not yet recorded the expense in our records. So if we recall back to the first slide, adjustments, an expense that we have not recorded yet would be an accrued expense. Okay. They've given us the amount. They're telling us it's 165 Rand and it's only for December. So it doesn't look like there's any calculation that we need to do. And therefore, it's as simple as our journal entry. Because we have not recorded the expense, we now have to record it. That is why we debit telephone expense to record the expense for December and credit accrued expense. Okay. So this one was quite simple, no calculation needed, simple. We have an expense that we have not yet paid, so we need to record that expense. Debit the expense and credit accrued expense. Okay. Then we'll move on to 2.8. So this is where the depreciation and the assets come in. Okay, so 2.8 now says equipment of 2,000 Rand, and they tell us it's a cost price, was purchased on the 1st of July. And it also tells us that equipment is calculated 10% per annum on the diminishing balance method. So what I did here was I just put a snippet from the trial balance so we don't have to go back and forward. So this is what the pre-adjusting trial balance has. It has vehicles at 40,000, equipment of 9,000. So the first thing we need to see is they are telling us only about equipment of 2,000, but we see equipment of 9,000 here at a cost. That means that we already had equipment before we bought this equipment. So 2,000 Rand we bought on the 1st of July. The rest, which would be 7,000 Rand, 9,000, which we have at year end, which includes the 2,000, minus this 2,000 is then equipment we would have already bought in previous years, let's assume, because they don't give us any other information. Okay. And they tell us equipment is calculated on 10% of the diminishing balance method. Okay, so that is giving us this statement here, is telling us how to calculate the accumulated depreciation. Okay, so the first thing that we need to now from this information realize is we see an asset, we've bought a new asset, and they've given us the depreciation policy. So we need to calculate depreciation on that asset. Okay, so the first thing we do is we've now got the new equipment, which is the 2,000 Rand. So you take the cost price of the new equipment, multiply it by the percentage, which is the 10%. And we only bought this equipment on the 1st of July. So for this equipment, we can only calculate depreciation from July 20.1 to December 20.1. So that is 6 months because we didn't buy the equipment before. So we can't calculate depreciation for 12 months. We can only calculate it from the date of purchase. So if we do that, we then get to the depreciation of 100 Rand. Okay. What is important here is it doesn't stop here. Just because they've told us that about this new equipment, we must go and put the pieces together and say, but wait, equipment on the pre-adjusted trial balance is 9,000. We're only calculating depreciation on 2,000. That means that there's equipment that we bought in previous years that we also need to calculate depreciation on. So then our assumption is, okay, there's other equipment that we also need to calculate depreciation on because when you calculate depreciation, you have to do it for all the equipment for the full year. So what we have done now is only done the calculation for the new equipment that was bought during the year. But because we have 9,000 at year end, and we know we bought 2,000 during the year, that means that there was 7,000 Rand worth of equipment that we had from previous years. Okay, so that is why I then say now we need to calculate the depreciation for the other equipment, which would be the equipment we had before we bought this new one. So I say 9,000, which is the value of all the equipment at year end, minus the 2,000, because the 2,000 is what we bought during the year and we've calculated the depreciation separately. That will give us 7,000. Okay, then next important point when it comes to assets and depreciation, there are two types of ways to calculate depreciation. This question has asked us to do it on diminishing balance method. And what diminishing balance method means is it's on the carrying value or the net book value. So that means if it's on the diminishing balance, you have to take the cost price, and this is the cost price, 7,000 Rand is the cost price of the old equipment. And then you've got to minus the depreciation that's already recorded. And that you would get from here, the accumulated depreciation. So this is what was calculated in the prior years relating to this equipment of 7,000. So you minus that, that gives you your carrying amount. And you multiply that amount by your 10%. And the only reason we do it cost minus accumulated depreciation times by the percentage is because they said diminishing balance method. That is the method. When you see diminishing balance method, it's cost minus accumulated depreciation multiplied by the percentage or write-off percentage. Okay, so that is now the two elements. So it's just important when you guys see a question like this, don't just look at the question or information and just use the information, because if you only did that, you would have only calculated the first line. Go back and check what is the pre-adjusting trial balance telling me. It's telling me we've got more. So there is more than one item. There's old equipment and there's new equipment. And so we need to calculate the depreciation on both. And then that together, the sum of the two is the depreciation for the year, for equipment specifically. So that is why depreciation is an expense. So we debit depreciation of 629 Rand, which is the sum of the 529 plus 100, because they didn't say calculate the depreciation of the equipment for the new equipment only. It says do it for equipment in total. So that is why we have to do both the calculations and debit depreciation of 629 and credit accumulated depreciation of equipment. I know I haven't addressed the vehicles part yet. We'll address the vehicles part on the next slide, but I'll just stop here because there's a lot of questions about the diminishing balance method. Okay, so I'll just repeat, whenever you see assets being equipment, vehicles, buildings, etc., any asset, they will come with a depreciation policy in order to write it off every year. So the two types that we get is the normal straight balance method, which we are not looking at in this example. The other option is the diminishing balance method. So the diminishing balance method says you must take the cost of your equipment minus the accumulated depreciation. So cost of your equipment, 7,000 for the old equipment, minus the accumulated depreciation, which is given to us in the question or in the trial balance. That gives you your carrying amount, cost minus accumulated depreciation, multiply that by the percentage to get your depreciation. Okay. The straight line method is the other option. It's not in these questions. You guys will see it when going through the learning unit on assets. The straight balance method is very simple. It just, you take the cost multiplied by the percentage. So that is why straight balance method, the word straight just means take it as it is. So you take your cost price multiplied by the percentage. Diminishing balance method says cost minus accumulated depreciation and multiply that value by the percentage. So that's this. Okay. Just waiting to see if there's any more questions before I move on to the vehicle side.
I think tackle this one. Didn't we use the diminishing balance method on new equipment? Why new equipment and other equipments calculated differently?
Okay, so that's a very good question. And the answer is also very simple, right? The equipment was only bought during this year. So because the new equipment was only bought on the 1st of July, so in the current year, there is no accumulated depreciation. Remember, accumulated depreciation is the sum of all the prior year's depreciation. So if you only bought the asset for the first time in the current year, there is no accumulated depreciation on it because you only bought it this year and you're calculating depreciation for the first time. And that is why there's nothing to minus. So there's no minus 2,000 minus something because there is no accumulated depreciation on the new equipment. The accumulated depreciation that we see here of the 1,710 would be from prior years. because the only way accumulated depreciation comes about is with calculating the first year of depreciation will give you the accumulated depreciation at the end of the year. So for any equipment or vehicles or any asset that needs diminishing balance to be used, if the asset is purchased in the current year, you will say the diminishing balance method will still say cost minus accumulated depreciation, but because it's a new equipment or asset, you will have no accumulated depreciation. So it will just be the cost multiplied by the percentages. But next year, if we were now in 20.2, this new equipment would be 2,000 minus 100, because the 100 would be the accumulated depreciation multiplied by the 10%. So I hope that makes sense.
Thank you.
Okay. I do also see a question about why do we assume that the 9,000 here includes the 2,000? Because the reason we assume it is because they don't tell us it wasn't recorded. So they just give us the information, but nowhere here does it say the equipment was not recorded, the purchase of the new equipment. So if they said the purchase of the new equipment was not recorded, then we couldn't make the assumption I made. But because they say nothing, we assume that it is included. In previous examples, if you guys think back to one of the previous ones, it clearly said this has not been recorded. I think the telephone expense. So if it tells you in the information it hasn't been recorded, then you know it's not in your pre-adjusting trial balance. But if it says nothing, and also if you look at the fact that there is accumulated depreciation based on what I just explained, you would know that there has to be other equipment. So the logic would be then to reduce it. But even if, let's say, you miss that point and you don't do that, you would still get marks for calculating the diminishing balance method. You would just use 9,000 minus 1,710 multiplied by 10%. So you would still have the logic correct, but you would just not reduce this. But it's important, I think, to first look at all the information in the question and read the information provided in detail. Because if it's not explicitly mentioned that it's excluded, we assume it is already recorded in all instances. Okay. Then I'll move on to vehicles. I think this will be a good second one to just re-go through the logic. So the second part just now shows us vehicles, and they say vehicles are calculated at 20% of the diminishing balance method. So here there's no additional information that says new vehicles were purchased or anything else about vehicles. So if there's nothing else given, we then go back to the trial balance. We see vehicles is 40,000 as the cost. Accumulated depreciation at the beginning of the year is 11,200. So now we just do a straight calculation of depreciation for the current year. So we know it's still depreciation. There's no new vehicles bought during the year because there's no explicit information where we're told that. So here, diminishing balance method, cost 40,000 minus accumulated depreciation 11,200 equals to your carrying value multiplied by 20%. And you're calculating it for the full 12 months. So you don't need to only do it for a few months. Like the previous one, we did the equipment only for 6 months because it was new and it was bought only for half the year. Whereas these vehicles have been there the full 12 months, and that is the reason why we just multiplied by 20%. This is then depreciation for the full 12 months. The journal entry would be very similar: debit depreciation, credit accumulated depreciation. So I see a few points here that I just want to go back to this. So sorry for moving. The way I showed it on the slides is a little bit different. But if you look here in 2.8, they just give you the equipment purchased. And in 2.9, they give us the depreciation. So I just, when I did the slides, put the the depreciation of the 10% already with 2.8, so it's with the information. But they give you both the information, and that means this information means you need to calculate the depreciation, and this just gives us the depreciation policy for the two. So by looking at it in this way, you need, in order to do anything with this information in 2.8, you would have to go to 2.9 and find what is the depreciation policy for equipment to calculate it. Okay. Okay, I'll just wait another minute and see if there's any specific questions. Okay, there's a question, how do we calculate the new equipment calculation? Because someone gets a different answer. While we're on the depreciation, I would like to just go back to 2.8 to the equipment. So the new equipment is, it's stated in the information, equipment of 2,000 was purchased on the 1st of July, and the depreciation policy is 10% on the diminishing balance method. So for the new equipment, you would take the 2,000, which is the new equipment. In this case, it's diminishing balance method, so you would normally minus the accumulated depreciation. But because it's the first year and we've only had this for 6 months, it's the first time we're calculating depreciation. So you would minus 0 because there is no opening balance of accumulated depreciation. And then multiply it by 10%. That is the percentage for the equipment for the depreciation policy. And because we've only had this equipment for 6 months, our year end is 31st of December, we bought it on the 1st of July, you calculate depreciation for 6 months. Okay.
Maybe, ma'am, we
yes.
can rephrase it in this way. I think the confusion here, they don't understand that the trial balance is at the 31st of December. So in actual fact, this is a question that is a bit maybe shaky in a sense that you won't understand why is the 2,000 coming in. But the 2,000 is already included on the balance of the 9,000, which is at the year end, which is the 31st of December. Hence, you minus the 2,000.
Yes, that's a good way of rephrasing it. Thank you for that. So if we just look at the pre-adjusting trial balance again, it tells us it's as at the 31st of December. And if we look at equipment, the value is 9,000. And in the additional information, they tell us that equipment of 2,000 was purchased in the year. So if the pre-adjusting trial balance is already at the 31st of December, the 2,000 must have been recorded in this number. Okay. Thank you for the clarification.
Sure.
Okay. Then we'll move to 2.10. Okay, so 2.10 now says the account of loose ends, a debtor who owes us 200 Rand must be written off as irrecoverable. So this is a debtor who owes us money, but essentially when it says it must be written off as irrecoverable, that's an indication that we have what we call a bad debt or credit loss. It's the same thing, just two different words. The accounting definition officially is credit losses. Okay, how do we then account for this? They give us the amount, so there's no calculation. They're telling us that it's 200 Rand, and that means if it needs to be written off as irrecoverable, it's basically a loss for us or a cost or an expense. And so that is why we debit credit losses as an expense and credit trade receivables. It was a trade receivable, which is an asset, it was sitting as a debit asset. Now the money is no longer recoverable, so we need to reduce the asset. That is why we credit trade receivables, and we need to incur the loss, which is an expense, and that is why we debit credit losses. Okay, this one's quite simple, I think, from the fact there's no calculation needed. And then the last one, if we go to 2.11, is it was determined that on the 31st of December, so that's our year end, the allowance for credit losses should be 250 Rand. And I just took a snippet from the pre-adjusting trial balance. I'll just show it again. So it shows currently that the allowance for credit losses as at the 31st of December that's in the trial balance now is 300. And they are saying in the information, it was determined that it should be 250. So if it's 300 and it needs to become 250, that means we would need to reduce it. So the first thing is, what is it? It's an allowance for credit loss. They've given it to us already, and it's one of the types of adjustments. How do we then do it? We have 300 that's currently in our trial balance, and we need to reduce it by 50. Okay? Or sorry, we need to reduce it to 250. And that means we need a calculation to say currently in the trial balance we have 300. The amount needs to be 250, so we need to make an adjustment of 50 Rand. So we would debit our allowance for credit losses of 50 and credit losses of 50. Because the amount that's currently recorded is too high, we need to reduce it. And that is why we debit the allowance for credit losses and credit losses. So this is an income for us, and this is reducing the allowance or the liability that is on the balance sheet. There's a question about debtors allowances. So just remember, credit losses is when we have money that is owed to us. So a customer buys something from us on credit, and then it goes as a debtor under trade debtors, which is an asset. And if we then have a policy that says on average there's a certain amount of people that are not able to pay, that's when we create the allowance for credit losses. Yes, so the 50 Rand comes back into the business. That is correct. It's a credit, so it becomes an income. We credit the 50, and so that is an income to us. Okay, I think that is it for the e-tutor question. So I think maybe before we wrap up, we can just give everybody a minute or two if you have any more questions to add it on the chat. For all of those who have their hands raised, unfortunately, you guys are not able to be unmuted. So if you can please just type your questions in the chat, we can then.
Teacher.
Yes.
Yeah, I will unmute them one by one.
Okay. Thank you.
So that they can ask questions. Let's start with Seropucho.
Okay. Seropuzo.
Allow Mike.
Hey, ma'am, am I audible?
Yes, you are.
Yes.
Ma'am, I didn't quite understand question 2.7.
Okay, let's go back there. Okay. Should I just repeat?
Yes, ma'am.
Okay, so here what it says is the telephone account of 165 Rand has not yet been paid. So that this is an expense to our business because we have a telephone account that we pay. And what this is saying is it has not been paid. That sentence indicates to us that it has not been recorded in we haven't recorded this transaction yet in our trial balance, which means, and they've given us the amount, our year is Jan to December. So it's correct that December has not been recorded, which means we have to now record December. So that is why we debit the expense of 165 Rand to record it and credit accrued expense because it has not been paid yet.
Oh, okay. I think I understand. Thank you, ma'am.
Okay, thank you.
Let's move to the second one. Rulani.
I think Rulani has resolved her question, his or her question. I see a comment. I withdraw. I found where the 300 is coming from. Okay.
Let's move to the next one.
The ZIPO.
28. I don't know the name. The student number 28786-750. Student number 28786. You can come in. Let's move to the next one. The next one is the next one. Nompumelelo. Nompumelelo.
Maybe while yes, you may just see a lot of questions about logging off. If you don't have any questions, you're welcome to log off, but those for questions, please stay.
Let's move to
there's also
Mapudi.
Zazipo.
Mapudi. Theophilus. Let's move to the next one. The next one is J. Kulu.
Yes, I'm here, sir.
Yes, we can
Hello.
hear you.
J. Kulu.
Yes. Will you go back to 2.8?
Okay. Yes.
And repeat the whole section, please. Because
Okay. Do you want to just ask your question first specifically? Is there something you don't understand, or is it just overall?
no, I don't understand where do you get that's 529, and then in the journal entry to debit depression, you only give us 629. Where do you get that 629 from?
Okay, so the 629 is the sum of the 529 plus the 100. So how we calculate it is they're basically telling us that we've got equipment of 2,000, which we purchased during the year. So we first calculate depreciation on that new equipment, which is the 2,000 multiplied by the 10%, and it's only for 6 months because our year end is 31st of December. So from July to December, we say times 6 over 12, that gives us 100 Rand of depreciation for equipment. But then there's the rest of the equipment. So at year end, we have equipment to a cost of 9,000, and we've now only calculated depreciation for 2,000. So that means we still have 7,000 Rand left, which is the 9,000 minus the 2,000, which we also need to calculate depreciation on. And that I refer to the other or old equipment. So we take the cost, which is the 9,000 minus the 2,000, minus then the accumulated depreciation of 1,710. Because it's on diminishing balance method, it must be cost less accumulated depreciation. And we multiply that by 10%. We don't apportion it for any portion of the year because the rest of the equipment we've now had for the whole year. So we just say multiplied by 10%. It's not like the new equipment, which only has 6 months in the current year.
Okay. Thank you.
Okay. Okay, thanks.
The next one is William. William. Let's move to the next one on the list. The next one is Ken. Ken. Ken.
Oh, sorry, I withdraw my question. I understand now. Thank you.
Thanks.
The next one is Tulisile.
Hi, Tim. My question is based on the last one. I'm not sure it's on 2.1, but
Okay.
I need a little more clarity on the credit loss.
Okay, is it this one, 2.11?
It's on the credit losses. So I want to understand that the credit loss, is it an asset?
No, the credit loss is actually a liability. It's an allowance for credit losses, which means that our asset is the debtor that owes us money. But in every company, there will be a policy that says, okay, some percentage of your debtors are not able to pay. And that percentage then becomes your allowance for credit losses.
Okay.
And that is why it's currently sitting at 300 Rand on the balance sheet as a credit. So the information saying it needs to reduce the 300 that we have created an allowance for people who might not pay is then reduced to 250. So that is why we end up in the journal, we credit an income of credit losses because the amount that we have is too high, 300, we need to reduce it to 250. And that 50 Rand then becomes an income to us.
Okay. Now I understand. So I thought it's for assets, but now I understand. Thank you so much.
Okay. Pleasure.
The next one is Zippo.
Could ma'am please clarify the telephone expense transaction for me, please? That's the only transaction I don't get now.
Okay, I'm going back shortly. Okay, here we go. Okay, so the telephone expense, here they're telling us that it has not yet been paid. So it's basically telling us that it has not been accounted for yet in the trial balance for that 1 month, because it's clear that it's only for the account for December has not been paid. So that means it's not in the trial balance, the 1 month's telephone expense. So that is why we debit telephone expense, because we debit the expense that to record it. So we're recording the December expense and we credit accrued expenses because it's not yet paid. So it's a trade payable.
Oh, okay, ma'am. Can you go to another question, please, again? Sorry. I just want to make sure. Can you please go back to the interest expense and the interest income one?
Okay. Interest expense was still, I think, 2.2. Okay. So here's interest expense. So here, similar to the telephone, we have a long-term borrowing and interest needs to be recorded. So we haven't recorded the interest expense. So it's exactly the same as telephone expense. It's also an expense. So that is why we debit interest expense. So the previous one, we debited telephone expense. Here we're debiting interest expense and we're crediting accrued expense, same as we did with the telephone.
Okay, it's clear now. Thank you, ma'am.
Thanks.
Thank you.
Okay.
The next one is Rulane. Rulane. Let's move to the next one. The next one is homolemo. Homolemo.
Hello, everyone.
Hello.
I'm just referring my question to 2.8.
Okay. Okay, I'm back when it shows.
So when I read 2.8, it only said equipment of 2,000 Rand was purchased on 1 July. I interpreted as, oh, it hasn't been entered into like the equipment account and the bank account. Because I totally understand the depreciation, how to do the diminishing. I just want to know, so if it says it was purchased, we then have to assume that it refers to the following question, 2.9, about depreciation. Because I thought it was just going to affect bank and equipment and not branch into the depreciation.
I think my colleagues can also jump in here if there's another way to explain it, but I get your question completely. They didn't. The 2.8 just said this first section, equipment was purchased on the 1st of July. They don't say that it's not recorded yet. They also don't say that it is recorded yet. So the logic I would use is normally very clear when it's not recorded. They would say that it's not, it has not yet been recorded. And I think if we go back to the trial balance, nothing on the trial balance just has a value of 9,000. It doesn't give you any additional information as to what is in that value. So if you look at a few PPE questions, it will be very similar. I don't think I've seen one that's different. It's usually, if they are very clear and they say that it hasn't been recorded, then you would know the first part, which you said you would need to record the actual equipment by saying debit equipment as an asset and credit bank, and not calculate the depreciation. I'm not sure, Maurice or Rasimati, do you guys have anything else maybe to add?
No, I agree with you.
Yeah, you said it well, but I'll just add, I'm thinking, Ernst earlier on has said, if the balance is saying as at 31st December, in your mind, it should tell you that I'm having an equipment of 9,000 at the end of the year. But now it comes again on the adjustment is saying, no, in July, I purchased 2,000. So the 2,000 is already included in the 9,000. But now they just want to make it as an adjustment so that you can make the calculation for that. So basically, if you see that question, you must understand that there's a balance as at the end of the year and the adjustment that has happened during the financial year.
Okay, I understand.
Sure.
Thank you.
Thanks.
The next one is Mududuzi.
Hello.
Hello.
I just wanted to ask, when we see prepaid expenses and accrued income, should we always view them as assets? And when we see income paid in advance and accrued expenses, should we view them as liabilities when we are dealing with these adjustments?
Okay, that's a good question. I will maybe go back. Let me close this and go back to the first thing. So I think in the learning unit, if I go back to the first two slides, which actually explains them, this is, I think, the base and the starting point. So you are correct. A prepaid expense would be seen as something we've paid in advance. So this would be an asset. An accrued expense would be the opposite. We have not yet paid this expense, so then it becomes a payable. And similarly with income received in advance, we've received it in advance versus accrued income. We have not yet received it. So your understanding is correct.
Oh, thank you.
Okay,
Sharp, sharp.
thanks.
The next one is Melissa.
Good evening, everyone. I just want to find out, I quite understand the class of today, but I feel like there are some times whereby when I'm studying by myself, I tend to get lost, and I just want to find out if is like a platform where I can get a hold of e-tutors in terms of maybe explaining something that I'm studying, and just for them to clarify for me.
So yes, there is definitely a platform. What e-tutor group are you included under? Do you know?
25E.
25E. Okay, so we'll just quickly I'll look on the side while we go to the next question. You should have an e-tutor that's allocated to you, and they should have on My UNISA, there should be a group where you should be able to engage with them on. So I'll just quickly find who the e-tutor is and I'll just type it on the group. They should also be available on some of the platforms. I'm not sure if you're already on the WhatsApp groups or any of the social medias.
I am, but the
Sorry,
problem
ma'am,
is
for
that
interrupting. Would you also please find out the e-tutor group for group 29E, please?
Okay.
so what happens is that there are no when it comes to discussion forums, they are not open for us to maybe ask a question directly to the e-tutor. It's always a thing of they need to be open. If they're not open, then we can't ask anything. That will mean that now when it comes to self-study, I'm literally stuck because I don't know how to get over something because there's communication via the e-tutor and myself as well.
Yeah, no, definitely understood. Maybe I'm putting the e-tutors details for both of those groups on here now. It's just their names, unfortunately. But if you guys can also just tell me what WhatsApp group you're in, we can get you guys in contact with your e-tutor because your e-tutors would already be or should already have contacted you guys and on your learning platforms have already given you guys options in terms of how they can you can get in contact with them and they would have separate classes other than these classes that are hosted mainly by the lecturers and a group of e-tutors. The individual e-tutors should also have a similar process. And in that way, they then via the WhatsApp groups or via the My UNISA platform, there's also a chat option where you should be able to contact them.
Okay, thank you so much.
Letitia, some of these e-tutors have been having login detail problems. So I think it's that kind of thing.
Yes, that's very possible.
Because this week I saw about 3 or 4 people that still had login problems. So meaning that if you go to my module, you might not find them.
That's a good.
Letitia?
Yes.
Guys, Joseph here. For students who have queries regarding the e-tutor groups, they can email me. I've attached my email address on the chat. I'll assist them.
Thank you, Mr. Satole.
Yes, we do have e-tutors who are currently having access issues, but the majority of the e-tutors are fine. So all the students can just email me, I'll assist.
Thank you, sir.
Thank you.
Paulina, are you sorted?
No, I am not sorted. I want to ask regarding.
You can come in.
Oh, yes. Evening. Good evening. I want to ask regarding 2.1.
Okay.
Packaging materials. Packaging materials is a subcategory under expenses. So it means that it increases on the debit side. I don't understand why we are crediting it here.
Okay. So let's go back to the trial balance. So here on the trial balance, you can see packaging material is here as a cost and it's on the debit side 4,700. So what this is telling us is that for the year until the 31st of December, we have bought packaging material for the value of 4,700. Okay, so that's the first thing that's just important to get from this information is when you see packaging material, immediately you realize, okay, it's actually inventory. It's a category of inventory. And they're telling us in the information that there is an amount of 980 Rand that is still there at year end. So it hasn't been used. And so what we now have to do is it's sitting as an expense in the income statement, that 4,700 in that's 4,700, 980 Rand is included. So what it's telling us, we haven't utilized it. So because it hasn't been used, it can't be an expense at year end because it hasn't actually been used. It's still sitting there and we will then use it in the next year. January 20.2. So that is the reason why you credit it. So you're reducing the expense, I-980, and you're debiting it as an asset because it's telling you that it's what's still remaining at year end.
Okay, okay. Thank you very much. Thank you.
Okay, sure.
Kenneth? 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 Let's move to the next one. The next one is Mangaliso. Mangaliso? Mangaliso?
Sorry. My question is not necessarily on the topics that we've discussed today, but I just want to confirm, Ugozi, on YouTube, right, from the link that you guys posted on my modules, will I get all of the lessons? Because I missed a lot of lessons due to personal issues, but now that I'm finally back online, will I find all of the lessons there on YouTube on the link that you guys posted?
Yes, even under announcements. If you click announcement, there's recordings under announcement for the previous classes.
Okay, then thank you, sir. That's all I needed to know. I just wanted to confirm that.
Oh, thank you. Let's move to the next one. The next one is Duma.
Hey, sir, can you hear me?
Yes, we can.
Yes, we can
Hello.
hear you.
Okay. I have a question on 2.8. Can you please go to 2.8, ma'am?
Sure.
My question is about the cost price. If we calculate it with the cost price method, I don't know whether this one is for today but I just wanted to ask if we calculate it with the cost price, not with the diminishing balance method. So on the second calculation, you said 9,000 minus 2,000 minus 1,710 Rand. So
Yes.
my question is, we were gonna minus, if we were calculating with the cost price, the 2,000 Rand, we were gonna minus it or not?
We would still do two calculations because of the time period. So your question, if I understand it correctly, is if we're using the straight balance method to calculate
Yes,
depreciation. So if we were using the straight balance method, we would still have to do two calculations. But because, well, actually, no. In reality, what we would do is it would be for this one, we could actually just take the 9,000. However, the period is still different. So we would still have to do two calculations. It would just look differently. So you'd still do this. This one would stay the same as is for the new equipment. For the rest of the equipment, you would just have 9,000 times 10%. 9,000
okay,
minus,
ma'am. Okay.
but it would because you've now, sorry, let me just re-clarify and maybe I'll type it on the chat. because you've calculated on the new equipment already the depreciation, you'd still have to minus the 2,000 to get the cost price of the remaining equipment, which would be 7,000. But you would not have to minus the accumulated depreciation. So this calculation would then look like 7,000 times 10%. And that's how you would get the depreciation for the rest of the equipment. You couldn't do it as one because there's a portion of the equipment that's only for half the year and the rest is for the full year.
Okay. Okay.
Does that make sense?
Okay.
Or
Okay.
maybe it can be rephrased in this way.
Yeah.
They can just not say equipment. They can say there was no equipment that was purchased during the financial year. So it means you are only sitting at the 9,000 only. There's nothing that was purchased during the financial year. So the second calculation will still be suffice. Instead of having the 629, then you'll only have the 521.29 because there's no portion that was purchased during the financial year.
Yes.
Clear? Or did that cause confusion?
I couldn't hear that one, sir.
Okay, I'm saying on 2.8, they can just say, put an adjustment, say they say there was no equipment that was purchased during the year. So it means
Yes.
only the equipment that we have is the 9,000 that is there on the trial balance. So in that way, the calculation for the
Yes.
first part is not going to be there at all. You'll only use the second calculation, which the depreciation is no longer going to be 629, it's going to be only the 529.
Yes, I think the question was if they were not using the diminishing balance method, but rather using the straight balance method.
Yeah, yeah.
In that case, the calculation would not minus this, but you would still need to do two calculations if you bought new equipment. If there was no equipment, then we would only, if it was the straight balance method and there was no new equipment, we would just simply take 9,000 times 10% on the straight balance method. But because there's still equipment bought, we would still, I think you were, if I understand the question correctly, you were just trying to understand if it was on the straight balance method, could we then just do one calculation and not do two separate? But I think it's important because the equipment that was bought during the year is only for half of the year. There would still need to be two calculations. I think, Duma, do we?
Yeah, I agree.
Yeah.
Are you okay?
I agree.
Yeah, I got it.
Okay.
Yeah. And
No, I got it.
The important thing is to understand the question. What is
Yeah,
it?
I am.
So reread the question up until you understand it, then you'll be able to answer it correctly.
No problem, sir. Thank you so much.
Sure.
Thank you.
Thanks.
Thank you, ma'am.
Okay, let's move on. Mkulu. Mkulu.
Okay, thank you. Ma'am, can you please go back to 2.2 and then my next question will be 2.10.
Okay. There we go.
Okay, thank you. Okay, ma'am, my issue is the biannually part. What's in my understanding, if I was doing this thing alone with no one, I would consider the biannually part and just say 3 divided by 6, just to consider the biannually part. I don't know if you can explain it to me.
Okay, so I think there, by saying it's the comment that says it's payable biannually, that's just telling us that it's biannually means twice a year. So we pay the interest twice a year. That statement there doesn't link to the fact that it's still 18% for the full year. So essentially, when you're calculating the 25,000, and because it's the information here is the loan was taken out on the 1st of October. So in your way, potentially, you, if I understand your question correctly, you would have said 25,000 multiplied by 18% multiplied by 3 divided by 6.
Yes.
Is that what you mean? Because it said biannually. Okay, but important that your 18% is for the full year. So the interest is payable biannually is only explaining how we should pay it. It doesn't necessarily link to how we should record the expense for the period. Because we only started on the 1st of October, there's 3 months. And because we're multiplying it by 18% and 18% is for the full year, you would still have to multiply it by 3 divided by 12. So I think important to not use to get confused by this statement, because this statement is purely just telling you how we pay it, but it's not telling you how we record or calculate the expense. The 18% is still for a full year. So whenever you're doing an interest calculation, you'll always have to divide by 12 and multiply by the number of months that we haven't recorded it yet for. Does that make sense?
Yes, it does. Thank you. And again, ma'am, can you please go to 2.10? I missed the whole part because of network.
2.10. Okay. So 2.10 is telling us that there's an account, a debtor, so somebody that owes us money, a debtor is a trade receivable. They owe us 200 Rand, but it must be written off as irrecoverable. So basically they're telling us that this person is not going to settle and pay us. That's what the written off as irrecoverable means. So that is a credit loss. So we initially had it as an asset, trade receivable of 200 Rand on our balance sheet. But now they're telling us that this person's no longer going to pay us. So we have to write it off as a loss. So that is why we debit credit losses, because that's an expense or a cost for us. And we credit trade receivables because it was an asset that has a debit balance, but now we're no longer going to receive it. So we reduce the asset and we debit the expense or the loss that we now will incur.
Thank you, ma'am. I get it. Thank you.
Okay. Thanks.
The next one is Simpiwe.
Can you please repeat 2.4 for me, please? I think I got confused there because on I know that we debit income increases on the credit side, but here we did I think vice versa. Can you just please clarify that for me, please?
Okay, sure. So here in this one, they tell us that the rental income that's recorded in our trial balance, which is 15,600. So in our pre-trial balance, it says rental income of 15,600. It's telling us here that it includes an amount paid for January 20.2. So that is the next year. Our financial year is Jan to December 20.1. So what this is telling us is in this 15,600, we've actually paid, or sorry, we've received rental for 13 months and not 12. So in our income, which you are correct, is a credit, we have too much in the current year. We can't have the next year's income. So that is why we debit. So currently the 15,600 is a credit, it's an income. So we now have to reduce it with the 1 month. That is why we debit rental income. So we're taking out the 1 month that's there that shouldn't be there.
Oh, okay. Thank you so much. Now I understand.
Okay.
Thank you.
Pleasure.
The next one is Robert. Robert?
Yes, good evening, guys.
Good evening.
Hi.
Yes, ma'am. I just asked that I see the slide for the vehicle depreciation. That's all I'm asking for.
Okay,
Because
sure.
I've missed it. I've missed it due to the network.
So just for the vehicles.
Just for the vehicles. As for the rest, I'm all right.
Okay, so here it is when you can see it. So
I'm all right. I'm all right. Thank you very much. I'll understand what's going on here.
okay.
All right. Thanks.
Pleasure.
Pleasure.
The next one is Sishi. Sishi.
Yes, no, my one is easy. Our assigned e-tutors, are they going to cover this as well?
Can I take that?
Yes, please.
Not the entire slides. We only take questions and then we respond to them. So whatever that you're asking, yeah, we can still ask that to your e-tutor, and they can just explain it to you.
Okay, thank you. Okay.
Sure.
And see, she just the slides and the recording will also be shared on
That
the
will help.
announcements.
Thank you very much. Yes, excellent. Thank you.
Okay.
The next one is gift. Gift. Let's move to the next one. The next one is Andrew. Andrew.
Sorry, are you referring to me?
Yes.
Sorry.
Sorry,
Well,
I'm referring to him.
No one calls me Andrew, but they call me Smart, but that's fine. Sure. I think my question just relates to the
Hi.
Hi, sorry, can you hear me?
Hi guys, am I audible?
I think we have two people now. Yes, so we can hear you, Gift, but we're just busy with Simanga. We'll come back to you, Gift.
Okay,
You
no
can just
problem.
wait a minute. Thanks. Yes, Simanga.
Yeah, my question relates to just some of the entries that you make. Like for instance, we've got I think in 2.5 we've got the journal entry will be accrued income for debit, and credit will be interest on invest. So like we understand, accrued income is obviously an asset, yeah, and I would then also assume interest on invest should be some form of an asset or something positive, right?
Yes, it's actually the income side of it. So what 2.5 is basically saying is that we haven't received interest income for 2 months, the last 2 months of the year. So that means on the income side, in the income statement, you don't have 2 months of interest income. So that is why we are crediting interest income here to increase the income that is owed to us. But because we haven't received it yet, we debit accrued income, which is then an asset. You are right.
Yeah.
So you debit the asset and credit the income in the income statement. So this would be an opposite of an expense, this interest income.
Okay. No, I've got it. Gotcha.
Okay.
Thanks.
Okay. I think Gift was next.
Yeah, yes. Hi, Letitia, thanks. I do understand today's lesson and I'm happy, I'm satisfied, thank you. But I've got one issue. Okay, so with regards to these solutions that we've just done, when it comes to the question being posed to you, when it comes to responding, do we just do this, what you just did? Or is it going to be tabled or something like that?
Maybe just clarify your question. Do you mean like, do we have a recording where we share these? Or do you mean when you are faced with a question in a test, when you need to answer it, how do you go about answering it?
How do you go about answering it? Do you just write it out, or is there going to be a table that you have to like fill out, or like I'm confused in
Okay.
that regard.
Okay, so I did the slides. Okay, that's a great question. Let me just go back a few. I prepared the slides in a way that we can sort of do it as a lesson. However, the question, if you get it in a question, if you go to the e-tutor question, what you will find is the first one that just gives you the pre-adjustment trial balance. And the second slide here just tells you the additional information. The required simply says prepare the journal entries. So because this is all you need to do, the answer would need to show the debit, the credit, the amount, and the description. So maybe let me just also bring up the solution. This is what the solution would be to this question. I've just in the class put it in a way that we can go through it in detail. Sorry, let me just make it a bit bigger. Do you see the solution? Because it simply asks for the journals. So
Okay,
you
now
show the debit and the credit and a description.
yeah, it makes perfect sense now.
Okay.
Okay, thank you so much.
Okay. Sure.
The next one is Uleboheng.
Good evening, Prof. Good evening, Letitia. Am I audible?
Yes, you are.
I just wanted to ask regarding transaction 2.10. I think that's the part credit losses, the one. No, it's 2.11.
Okay.
Is it not that credit losses in its nature is an expense account, and then the reason it was credited here is to make an adjustment to the original credit loss amount? Because I saw some students writing on the chats that credit loss is an income, and then I wasn't sure if in its true nature is it an income account, or was it because of the adjustment that we're making to the allowance for credit losses?
So the latter of what you just said. So um, you are correct. Credit losses are in general a cost. So let's look at 2.10. I think this is a good way of showing it. So 2.10 is a credit loss. This is one where it needs to be written off. So therefore it's a loss, debit expense and credit trade receivable. So this is in its true nature what a credit loss is. The allowance for credit loss is then where a company has a policy, just like a depreciation policy, a company will have a policy on how to then create an allowance for credit losses. And that will result in a calculation, and that will give you an amount that you then show as a potential liability. So on the pre-adjusting trial balance, let me just go back there. Sorry, not that one. The actual file. Okay, so you can basically see here allowance for credit losses. It's showing as a credit. And that is because, and it's sitting, if you look at where it's sitting with all your payables, all your liabilities. So
Yes,
this
it's a
is your long-term
provision.
debt. Yes, it's a provision, exactly. So it is a provision for potential future losses. So when you raise it initially for the first time, you would debit expense and credit allowance for credit losses to get to the 300.
Okay.
Then in this case, what they're saying is now you must reduce it because the amount we have, the provision we have is too much. So because we have to reduce it by 50 Rand, that is why we credit it here.
Oh,
So
we
it
credit
becomes an
credit
income.
losses.
Yeah, so it becomes an income for us because now we need to reduce the allowance.
Okay. So the adjustment is then the income, not necessarily the nature of credit losses.
Exactly, 100% correct.
Okay, thank you.
Okay, thanks.
The next one is evidence. Evidence. Let's move to the next one. The next one is Hashani. Hashani.
Hello, can you hear me?
Yes.
Yes, I can see that we are recording the journal entries, but I don't understand if we see the general journal or the general ledger, because I can see that it's a double entry system.
So I think, let me just go back. So if I go here, well, let's go back to the question. It doesn't specifically say either. So it just says journal entries. So when it says just prepare the journal entries, you're doing the debit and credit, which would be in this format. So it's not as detailed as when you do the general ledger in a T account format, or where you do the first step of the adjustments, but it's essentially the actual journals you are posting after you have recorded the transactions.
Okay, but I'm answered because I can see that it's a general journal format.
Yes.
Can you hear me?
Yes, I can hear you.
Yes, I can see that it's a general journal. But according to these answers, it's the general journal.
And according to the question, it says prepare the journal entries.
Yes, but it doesn't
Okay.
specify.
Yes, it doesn't specify. Maybe I'm not sure if any of my colleagues have a different suggestion or explanation.
Okay, my second question. Okay.
Okay. I think she's covered.
Okay. Yes, your second question.
My second question is that will it be the first assessment be a quiz or assignment, a written assignment?
Okay, maybe we can have the lecturers jumping in here.
There's no written assessment for FAC 1502.
Only the quiz.
Yeah, only the quizzes, yeah.
Thank you so much.
Oh, thank you.
I'm answered correctly and I'm fine.
Thank you.
Let's move to evidence. 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 All evidence still sorting. Hi.
I wanted to ask, where do I get the recorded lesson?
The announcement on my UNISA or under our FAC 1502 YouTube channel. The links for YouTube channel, WhatsApp groups, Telegram groups, they're under our welcome message on the module site. Evidence, is there any question from you?
No.
Evidence, is there any questions?
No.
Oh, thank you. Let's move to Segopotso. Segopotso.
Sorry, sir. My question has been answered. It's okay.
Okay, I think we've been through everybody.
Yes, we are done with the hands. There is the last one. Let's hear this. The last one from Bokang. Bokang. Bokang.
Yeah, yes. Can you hear me, sir?
Yes.
All right. Thank you. My answer has been answered. So thank you. I was just trying to. I'll lower my hands. Thank you.
Okay.
Sorry, I do have one question. Quickly, in the assessment, can you use a cell phone, or do you need to use a calculator in the assessments?
Mine, I prefer calculator.
Okay, thank you.
Oh, thank you.
Okay. I think
we are done with the hands.
Okay, great. Okay, then I think from our side, from the 3 tutors that presented, thank you all for attending. And as we mentioned, the presentation as well as the recording will be shared by the lecturers under the announcements. And yes, thanks for your participation, and thanks to my colleagues as well, Maurice and Risimita, and have a good evening. Then if there's nothing else.
Oh, thank you.
Thank you.
Thank you.